Okay, so in an effort towards getting you fully prepared for your exams, today we are going to be moving forward and we are going to be treating another very important topic in your syllabus, which is analysis and interpretation of financial statements. I think after this class, I would have one more class or two more classes with you guys for revisions. After this one, I'll have one more class, then another one for revisions. I think we'll have two more classes after today. So my focus today is to also teach you analysis and interpretation of financial statements. So a point of note is this. Last week, we looked at non-financial disclosures in the annual report. That topic is 20% of your syllabus. You don't want to joke with it. So that note I sent to you, coupled with the past questions attached, you should take it highly seriously. So this topic I'm teaching you, together with EPS that Mr. Kazim has taught you, that is also 20% of your syllabus. You have to know those ones before you enter the exam. And there is one other one on ethics. I'll be teaching you ethics next week. That's also 5% of your syllabus. The first topic I taught you on regulatory and conceptual framework, that is 10% of your syllabus. Those are the key to passing CR exam. It's not group account or accounting standard that makes students pass CR exams. It is those key areas, simple, straightforward, but it's key. But unfortunately, group account and accounting standards, they take a lot of our time, a lot. And group account is just 25% of your syllabus. Accounting standard is just 20% of your syllabus. You just need to at least have an average knowledge. And why we find out that at NetWorth, our students hardly fail CR because we will have overtold them over and over again where to focus. The ones that fail are the ones that decide not to listen and spend the whole of the time reading accounting standard and group. They will get to the exam, they will be shocked that all these areas are where you will find them. So we are still going to talk more about that in the remaining 2 weeks we have for this class. However, let's focus on what we have today, which is speaking to analysis and interpretation of financial statements. So I'll go straight to the point tonight. So when it comes to analysis, there are certain tools that are used for analyzing financial statements. And the key tools is ratios. So basically, what I want to teach you tonight are ratios. So going straight to the point, the first thing you need to know are the categories of ratios. So we're going to look at these 5 categories of ratios. The first one is profitability ratios. Then we'll look at working capital ratios. In your exam, you find out that they will mostly call these efficiency ratios. In all your exams, they call these efficiency ratios. Then we have liquidity ratios. Then we have debt ratios. They could also call these solvency ratios. Then there is investors or shareholders ratios. Okay, so these are the 5 categories of ratio you would find in your exam, and you need to understand them because I want to believe that for most of you here, this is not the first time you are going to be taught ratios. I will just focus on the key and salient things you need to note for your exams. That's what I will do. Then we would round our class for today. So let me start with profitability ratios. Now, the first and most important profitability ratio you need to know for your exam is ROCE, which is return on capital employed. most of you will know that what this ratio measures is the amount of profits that an entity is able to earn from the capital it has available. The amount of profit an entity is able to earn from its capital, right? Or its ability to convert its capital to profit. Now, from that description of this ratio, the formula is this: is profits all upon capital employed multiplied by 100. Now, in the exam, the examiner, in most of your question, at least most diets, except last diet, where the examiner didn't even ask you to calculate ratio at all the examiner asked you to do was to analyze. That last diet was interesting. I would really love to look at it if you have extra time today, or probably next week after we are done with ethics. However, in most of your questions, you'll find out that the examiner will give you capital employed. And the capital employed the examiner gives you is what you must use. Now, the capital employed that is given is what will now inform the profits you are going to use. What am I saying? You see, when we say capital employed, it is either just equity. It's either just equity. The examiner will tell you that you assume the capital employed is equity. And equity is just share capital plus your reserves. Or the examiner can tell you that your capital employed is equity plus liabilities. They could specify non-current liabilities, or they might not. That means you might have to use maybe all liabilities, but in most cases, it's equity plus non-current liabilities. The examiner can ask you to use any of these two as your capital employed. If the examiner asks you to use any of these two, please, that is what you should use. That is what you have to use. Now, the most important thing for Rusi that I need you to hold is this. If the capital employed is defined as equity plus interest, then the profit you must use must be the profit attributable to both the equity and the debt holders. I repeat, if the capital employed you are required to use, or that you choose to use, is your equity plus debt, that is interest-bearing debt, that those are majorly non-current liabilities that you pay interest on, then the profit you must use must be your PBIT, or operating profit. PBIT or operating profit. Remember, when you look at your statement of profit or loss, there are different profits you will find there, starting from your gross profits to these operating profits, which are also called PBIT, profit before interest and tax. Then before you have PBT, then PAT. You see, this operating profits is speaking to the profits before you have paid interest. That means debt holders also have a share in these profits. That means this profit belongs to the debt holders and the shareholders. And that is why I'm saying that if the capital employed you are using is equity plus interest, interest-bearing debt, that is non-current liabilities that carry interest, then the profit you must use must be either of this operating profit, which is also called profit before interest and tax. However, if the PBIT that the examiner asks you to use is just, I say if the PBIT, if the capital employed that the examiner asks you to use or that you choose to use is just equity, If you are using just equity alone, that is this share capital plus reserve, then the profit you must use must be either your PBT or PAT, because that's the profit that belongs to the shareholders alone. Mostly we fondly use PAT. So please take care of that. That's what I need you to know in this OC here. However, if you are using this one, where the capital employed is just equity, which is shareholders plus reserves, and you are using PAT or PBT as your profits. Yes, is OC, but there's another name they call it, which is what I use as this second ratio. They also call that returns on equity, which is just PAT all upon equity. So I just intentionally put it as a separate ratio, but usually it is already captured in ROC. It's already captured in ROC already. So ROC is profit all upon capital employed, but be careful. The examiner might have defined capital employed for you. When they do that, please use the appropriate profits. If the capital employed is just your equity, then the profit must be your PAT. If the capital employed is equity plus interest-bearing debt, then your profit must be your PBIT. Please take note of that. All the notes are already written in your workbook. Okay, the next profitability ratio I will be looking at is profit margin. And profit margin is just the profit you make on every 1 naira of sales. The profit made on every 1 naira of sales, and it's profit over sales. So in most of your exams, you can break this profit margin into two. You can have gross profit margin, and you can also have operating profit margin. That operating profit margin, sometimes the examiner will call it net profit margin, but we see net profit here as operating profit, which is PBIT. And it's just profit over sales. And I'm sure you know that the higher this ratio, the better. And they are mostly, this one is in percentage, this profit margin. Sometimes you can put it in kobo, but mostly you can leave it in percentage. And the higher, the better. The higher, the better for any company when you are doing your analysis. Then we have asset turnover. There's a reason I'm putting this asset turnover under profitability. Ordinarily, it's more suitable for efficiency or working capital ratios. You will see it very soon. But what asset turnover mainly means is how well or the efficiency with which an entity is able to convert its capital into sales. How well or how efficient an entity is able to convert its capital into sales. And the formula is sales all upon capital employed. And what I need you to note here is this. In the exam, whatever capital employed they ask you to use in your OC, please, that is the same thing you should use here. In some questions, you will see this capital employed. In fact, that is the secret. Whatever capital employed you use in your OC, use it here. Just make sure you use the same basis. Okay? And that asset turnover. And asset turnover, I mean, is a function of it's more focused on sales. So you see that the focus on this is how you're able to use your capital to generate a lot of sales. Just is the turnover that this guy is focused on. And you see, like if you aggregate profit margin and asset turnover, you can explain your OC, right? So, I mean, a profit margin is profit over sales. Asset turnover is sales over capital employed. Sales can cancel out sales here. They can cancel that one another. Then we will be left with this row C of profit over capital employed. Okay. It's not like the examiner is really going to ask that. They have never asked explaining this, but mostly we see profit margin and asset turnover as a secondary ratio to OC. As a secondary ratio to OC. Okay. I wanted to ask a question. I'm just trying to remember. Okay, so that's your profitability ratio. I need you guys to confirm that you're here and you can hear me.
Okay, hear you, sir.
Okay, good. So I want to confirm something from you. There was a diet. The examiner asked a ratio that we did not teach our students. They call that ratio cost of sales ratio. Cost of sales ratio. So I'm just wondering, let's assume I didn't teach you because it's not even in this note. Let's assume I didn't teach you. So you now met that in the exam. Can any of you give it a shot? What do you think it will be? How would you calculate that? Cost of sales ratio. I just need you to try. I will tell you, but just try. Let's see.
Okay, so I think it should be total cost all over total sales, net sales, maybe times 100 over 1.
Okay, when you say total costs, you know that it's cost of sales ratio. So why not cost of sales over sales? Why are you using total cost? Because you would have been correct. And that's highly impressive of you. If you had said cost of sales over sales, that would have been a correct answer. So yes, you are correct. It's actually cost of sales all upon your sales. That's cost of sales ratio. It's just the amount of cost of sales incurred on every sales. So for every sales you were able to make, what was the cost of sales you incurred? It's just similar to profit margin, saying that okay, on every sales you were able to generate, how much gross profit did you make? Yeah. So the examiner didn't stop there that diet. The examiner went further. He did not give them cost of sales. He did not give them sales. Yet, he wanted them to calculate cost of sales ratio. The only thing he gave them was gross profit margin. The only thing he gave them was gross profit margin. And he gave them gross profit margin as 25%. So if you're faced with that, they gave us a gross profit margin of 25%. And they are asked that we should calculate cost of sales ratio. What will have been our cost of sales ratio?
75%.
That's correct. It's that simple. Fantastic. So since the profit margin is 25%, that is the gross profit we made on every sales. That means the differential is the cost of sales. Okay, I just need to be sure that you would note that. And another one is this. I wanted to ask something. What's that again? Guys. Okay, yes, I remember. Now, I wanted to ask something before I forget, before I move to the next category. This capital employed I was talking about here, I said that the examiner can either tell you share capital and reserve, which is equity, or they can tell you equity and non-current liabilities, that is interest-bearing debt. Okay, so you know that in your balance sheet, what figure will be equal to your equity in your statement of financial position on the upper part? Because what figure will be equal to your equity? Balance sheet must balance. Sorry, say it.
So I said what figure will be equal to equity?
Yes, in the statement of position.
Is ordinary shares plus reserve.
Yes, I know. Your statement of financial position must balance. Must be balanced. The upper part, that is the assets part, must be balanced with the equity and liabilities part. That's what I'm talking about. So if your equity is so much, what is it balancing with? What will be equal to it on the upper part of the statement of financial position?
Total assets.
Total assets. No. It's actually total assets minus total liabilities. That's what, that your I think my internet went off briefly. Hello?
We can hear you now.
Okay, good. So you know that in your statement of financial position, assets is equal to equity plus your liabilities. That's your statement of financial position. Now we are saying that what will be equal to your equity, if that's what we're looking at, is if you take this one to this other side, it will become negative. So is your total assets minus total liabilities will be equal to your equity. And this we call net assets. So your net asset can equate your equity. So I just need you to know, I just discovered I didn't mention it. So the examiner could tell you, because I've seen that before, that your capital employed should be your net assets. If they tell you that, please, it's the same thing as equity or assets minus total liabilities. Please. Now, the second one, so which is what she was saying, when it comes to equity plus liabilities, if I bring this back here, if you come to equity plus liabilities, then that one might be equal to your total assets, right? But even if the examiner specifying non-current liabilities alone, that means it's actually total assets minus current liabilities. That's what we equate equity plus non-current liabilities. Just take note of that. It's just about your understanding of those statements of financial position. Okay, so that is it for profitability ratios. Now let's go to working capital ratios. So I have working capital efficiency ratios and working capital turnover ratios. So these turnover ratios is not a thing anymore because mostly they don't have a reasonable interpretation. So that's why in the exam, you will find out that your examiner will simply call these working capital ratios. They just call it efficiency ratios. That's what you find in your exam. That is what you find, efficiency ratios. Okay, so you will not find working capital efficiency. Just take note of that. And the efficiency ratio we would be looking at is trade receivables collection period, inventory turnover period, and trade payables payment period. This trade receivable collection period simply is talking about the number of days it takes to collect your money from your receivables, the number of days it takes to collect money from your receivables, and is calculated as trade receivables all upon credit sales multiplied by 365 days. It is as simple as you're seeing it here. So if you're asked to calculate this in the exam, just get the trade receivables for the year in the statement of financial position, and you might not find credit sales, but you'll find sales. Use sales straight on. Right? I see that some people use this average receivables here. Please don't use average receivables. Use the trading receivables or trade receivables in the statement of financial position. That is what you should use. Then whatever you get will be the number of days it takes you to collect money from your receivables. And you agree with me that the earlier you collect your money, the better. So when we're analyzing, is the earlier the better, the lower the better for us. After that, the next one is inventory turnover period. And this talks about the number of days inventory is held in the store, in the warehouse before it is sold. Okay, it's like the number of days it takes us to sell our inventory. Number of days it takes us to sell our inventory. And for this, it's calculated as inventory over cost of sales. Inventory over cost of sales. Please, in the exam, use closing inventory. The inventory in the statement of financial position. Don't look for average inventory up and down. I see people saying that. Don't do that. You only waste your time. It's not going to give you any additional mark. So this closing inventory all upon cost of sales. That's whatever you get is the number of days it takes you to sell your inventory. And if this is too long, it will only show that you have too much inventory or you are unable to sell. That's what an elongated inventory turnover period will tell us. So this one, the
Sorry, sir.
shorter the better. Yeah, I'm with you.
Sorry, I wanted to ask, you said we should use the closing inventory. That is the
Yeah,
inventory in the statement of financial position.
that's correct.
Okay,
That's
thank
correct.
you.
Yeah. Okay. The next one is the trade payables turnover period. And this is just the number of days it takes you to pay your suppliers. The number of days it takes before you pay your suppliers. And it is calculated as trade payables all upon credit purchases multiplied by 365 days. Again, this is just the trade payables in the statement of financial position. In the exam, I'm 100% sure that you will not find credit purchases. And mostly, you will not see purchases. Please use cost of sales. Please take note of this particular one. Though this is a formula, quite agree. But if they don't give you your purchases direct, don't waste time calculating purchases. Please use cost of sales straight on. Use cost of sales. Then you'll be fine so that you can move and move. Okay. So whatever you get is the number of days it takes you to pay your suppliers. So I really want to hear from you guys, right? So if me, Wasil, it takes me 10 days to pay my suppliers, and it takes Fidelis 8 days to pay his suppliers. In terms of efficiency, because we are talking about efficiency ratio now, whom do you say is more efficient between me that is paying that is paying my suppliers within 10 days, and Fidelis that is paying each supplier within 8 days? I would like to hear from you guys. So, who is more efficient? Myself or Fidelis?
Fidelis, sir.
Fidelis. Okay. Any other idea before we go ahead and discuss it? Oh.
I think it will be dependent on your trade receivable. If the amount of days it takes you to pay is higher than the amount of rather if the amount of days it takes you to pay your creditors is higher than the amount of days that it takes you to receive.
That's fantastic. I fully agree with that. Yes. So, you see, we can't judge on the surface. Really, we judge payables by ensuring that, because by ensuring that it's the money we collect from our receivables that we will use to pay our suppliers. So we have to ensure that the period we negotiate with our supplier is longer than the period we have or we give our receivables, right? There has to be a gap there. That's a determinant. That's a major factor. However, beyond that, just looking at Fidelis that is paying within 8 days, and me that is paying within 10 days. Another thing we would use to determine that is what is the credit period given by the supplier. If you are paying within that period, if the credit period the supplier gives to Fidelis is 8 days or 9 days and is paying within 8 days, then fine. Me that I'm paying within 10 days, if the credit period my supplier gives me is 15 days and I'm paying within 10 days, that's also fine, because it is important that you don't ever exceed the credit period granted to you by your supplier. It's very important so that the guy will still want to give you another credit next time, because that is the only credit you will get that you will not pay interest. It's trade credit. The guy is giving you goods on credit. That's go and sell it. When you sell, come and pay me my money. It's like it's giving you capital. So you don't want to joke with that, right? So, and another thing is this: when we are doing analysis, right? When you're analyzing and you see that a company in period A or in 2022, for example, is having a trade payables period of 15 days. In the next year, it's now elongated, it becomes 20 days, right? Depending on the context, one of the observations in your analysis could be that the reason why this guy is extending or delaying its suppliers is because he might have liquidity problem. Because that's the only reason why you would want to delay your supplier. You see, when teaching you working capital management, I'm sure maybe you have done it in SFM. I'm sure your lecturer will have told you that you should delay those payments, and instead of paying, you should invest it in another interest yielding investment. No, that's wrong here. That's wrong. Don't invest another person's money, not a trade payables, not his own money. For us accountants, we will say you have liquidity problem, because that means you don't have working capital to operate. That is why you are using suppliers' money. When your receivables are paid, you pay your suppliers immediately. Don't delay his money. Otherwise, you will lose that free credit. Your credit rating is going to get poor and poorer, and you will not be able to get good credit terms in subsequent transactions. So generally, we won't be wrong if we conclude that the earlier the better here. even without sufficient information, the earlier the better. The earlier the better for your trade payables turnover period. Okay, now you see, these efficiency ratios are very powerful in the sense that by the time you aggregate the number of days it takes to collect money from your customers, which is trade receivables collection period, and the number of days it takes you to sell your inventory, which is the inventory turnover period, if you aggregate those two together, if this is, for example, 10 days, and this is, let me say, 7 days. You see, if you add these 10 days and 7 days together, what it means is the number of days it takes you to convert inventory to cash. Since it takes you 7 days to sell, and you would pursue this guy for another 10 days to collect your money. So cumulatively, 17 days to convert inventory to cash, which is fine. If you bring in payables period, because it's the money you collect from these guys, let's say this is now 12, that okay, you have collected your money, then you pay this guy. You pay this guy. And you know that is the goods you bought from this guy, right, that you were holding for 7 days. That, in fact, 12 days is not so good because you held the goods for 7 days. It takes you 10 days. That means almost 17 days before you can collect your money from your receivable. So ordinarily, you should negotiate 17 days with this guy, or even 18 days. By the time, but they might not give you that much days, really. Because if they give you, for example, 17 days, that means your cash cycle is 0, which is 10 plus 7 minus 17. We usually less this one from them because it's what you get from this that you used to set, so we less. So a company with a cash cycle of 0 is an extremely efficient company. Extremely efficient. So usually it will be 0. Let's say 12 days, for example, now. So in this case now, your cash cycle is 5 days, which means that it took you 5 days to start and end a transaction. From when you bought from your suppliers, you sold, then you collected your money back, then you paid back these guys. I mean, efficiency, 5 days, your cash cycle. So, you see, for cash cycle, which is also called operating cycle, the examiner can also call it conversion cycle. They could also call it trading cycle. They could even call it working capital cycle. They have called it all of those names at one point or the other. So, you see, that cycle has to be short. Is an ultimate measure of efficiency. The shorter that cycle, the better. Because if it becomes too long, it's a problem. It's a problem. It's a symptom of something. Do anybody have an idea of what that problem is? What is signified when you have an elongated cash cycle or operating cycle? Any guesses? What problem do you think that company is faced with? Okay, no guesses? See, that problem, we call it overtrading. A company with an excessive or elongated operating cycle, because it means its receivables is huge, its inventory is huge. This one too, everything is just huge. This one too will probably be huge. So that's why ultimately the cash cycle will be elongated. It means is overtrading. And to put it simply for you, when we say a company is overtrading, it simply means that that company is doing too many things, and he's trying to do those things very quickly. And unfortunately for the guy, he doesn't have the sufficient resources to achieve those things. So it's like doing a lot of activities too quickly with very little resources. With very little resources. It's just like an ICANN student. This is just like on the lighter mode, right? An ICANN student that wants to write 5 papers at professional level, and he doesn't have time. He's working, family woman, and he wants to write 5 papers. That's overtrading. If the person passes, probably because of luck or something like that. Some people do it and pass, but I mean, it's not ideal. That is what overtrading is looking at. Doing a lot of things too quickly. The ultimate thing is that it does not now have the resources. It's just like somebody that has a capital of 20 million. And he knows that this capital of 20 million, if he's going to, the capacity of this capital in terms of output, capacity is 10,000 units. I'm just saying 10,000 units. But my guy wants to do, he said that with this 20 million, that is aiming at 100,000 units. You see, if he's aiming at this and he is able to do it, it means that he is overtrading with the resources of 20 million. And the way you will know is this. When you look at his account, you will see that the only way he will have achieved these 100,000 units with these resources, well, number one is that he will be borrowing so much. He will be borrowing so much. Number two is that his bank balance will be negative. He will be having a negative bank balance. Number three is that there will be a sharp increase in revenue. Because, of course, he was able to do it, right? So his revenue, you'll be pushing out sales because inventory is plenty and you have an high level of inventory. Also, high level of inventory. And because he's trying to sell so much, he will be given some generous credit term that people will just be buying and they will not pay. So the inventory trade receivable levels itself will be on the high side. The trade receivable levels will be high. And because he doesn't have the resources, he will also have high trade payables because he will probably be buying from suppliers on credit. And he will have been buying a lot of non-current assets to fund this additional productive capacity. So all these are signs. Even beyond this, you see that his interest will be very high. He will make good profits, but that profit will not have quality because he doesn't have cash. A profit that is not backed up by available resources and cash doesn't have quality because you won't be able to pay dividend if your profit is not backed up by cash. But government does not want to hear that. As soon as you have huge profits, you pay a lot of tax. So his tax also will be going up. So it's a major issue. And as an accountant, you should be able to look at the financials and be able to spot a company that is overtrading. Now, how do we solve this problem? How do we prefer solution to these guys? Looking at these things, you can easily know from the borrowings now that is elongated, you can simply restructure those loans, restructure the loans. And when we say restructure loans, it's just that it means simply that you should adjust some of the terms of those loans. Like, for example, now you could have a sit down with your bank and renegotiate the interest. Okay, so maybe the accrued interest or the cumulated interest that has accrued over time is like 20 million. You can negotiate with your bank that I'm having liquidity problem. Please, let's close everything at 5 million. Help me, forgive me 15 million. People do that. So you can restructure the loans beyond interest forgiveness. You could also ask them for elongated period. They could accept, they might not accept, but at least make an attempt. Restructure the loans. Another one is this high level of inventory. You may probably will have to put more effort on marketing, but he's doing a lot of marketing for him to have sharp increase in revenue. But this high trade receivables is that he has sold to wrong set of people. He probably will have to engage the service of a factor to help me pursue that money. And a factor are guys that buy receivables. They buy receivables. And the way it works is that it's either they give you money in advance, like if your receivables is 100 million, they could give you 80 million and say that we will go after those receivables. And if we're able to get the 100 million, the 20 million is going to be our margin or our profit. Okay, so factor the receivables. And another one is that you could also try to negotiate with your suppliers. You can negotiate with suppliers for extended period. And also, more importantly, is that it can inject capital, right? If we can get somebody to give him money. Because if I have money, I'll give this kind of guy because he can move, he can sell, he has the drive. He just lacks resources. If this guy, if his hand touch resources, he will do so well. Okay? And yeah, these are solutions. What other one? Yeah, this non-current asset he has, PPEs and all of that he has used to produce. If he has any of them that are idle, he should sell idle assets. Okay, so these are some of the solutions to overtrading that I strongly believe that you need to be aware of as a corporate reporting student. Okay, so I'm done with efficiency ratio. Any question before I move to the next ratio? Any question? Okay, no questions. Now there is this turnover ratio. ICANN doesn't ask this anymore. Trade receivable turnover. It doesn't really make any sense because what they just did is just to reciprocate. I mean, move like we have trade receivable turnover now. They now put these credit purchases up and put this one down. It's just the reciprocal of those ones in days, right? So like trade receivable turnover, they put credit sales up, put trade receivable down, inventory turnover, cost of sales up. The only one I think is relevant is just this inventory turnover, which is the speed at which you're able to sell your inventory. This is the only one I think you should note here. Inventory turnover. You see this trade receivable turnover and trade, you can ignore those ones. Yeah. Yeah, I said so. Ignore them. Okay, we're almost there. The next one is liquidity ratios. The first liquidity ratio is current ratio, which looks at the availability of highly short-term assets to settle highly short-term liabilities. The availability of highly short-term assets to settle highly short-term liabilities. Some people will say the best is 2:1. I don't know who invented that. Well, what is important for us is that the higher this ratio, the better. And in the exam, this ratio is always being compared with previous years or with another entity or with industry average. The higher, the better. That's how we're going to judge the guy. If he has an high current ratio, yeah, it's good. It's good, right? However, there is a better ratio for liquidity than current ratio, which is quick ratio. Because quick ratio now removes highly or it removes a current asset that takes time to convert to cash. It removes them. And the popular one we remove is inventory. So that what we have as the numerator here is an item that we know we can easily convert to cash sharply. Then from that, we will get our numerator divided by current liabilities. It gives you that, it shows how prepared you are to settle your current liabilities, right? And that's quick ratio. And that's it. There's one I can add to this liquidity ratio. I can call that cash ratio. And it's just similar to this one, that instead of using all this, just use cash and cash equivalent as the numerator. So I believe that is even better than this quick ratio, because that one tells us that you have the cash available to settle your current liabilities. So it's even more reliable. So that's cash ratio. Now the next one is debt ratio, or sometimes they call it leverage ratio. So this ratio majorly is just looking at the ability of a company to settle its interests arising from interest-bearing debts. Because company that borrow and has to pay interest, they pay it every year, is fixed. So this ratio really looks at that. And with this ratio, we'll be able to tell whether a company is exposed to huge financial risk. If it is too high, it's not good. It can affect the going concern of the company. Because financial risk is the risk that you might not be able to pay interest and you'll be exposed to liquidation. Or the risk that the interest you pay will be so high that you will not be able to pay your shareholders dividend because there's no money. See, there's a difference between there is money and you now want to retain. You now want to retain that money for growth. And there is no money. There's a huge difference. So for those companies that has money but are not paying dividends, shareholders understand that, okay, maybe that's their own dividend policy. Maybe that's their growth strategy. Like Amazon. Amazon for a very long time did not pay dividend to shareholders. And it helped, it paid off. At the point they were the most capitalized company in the world, right? Even now, I think they are the third or the second after Apple, though all these AI companies are taking over now, but they did so well. So that's debt ratio, and we're going to be looking at these four ratios for that. The first one, this one looks at your total debt on your total assets. So weighing that, what is the total, the proportion of the debt that you are using to finance your assets. So this one, if it is too high, is a problem. It's a huge problem. And note, this total debt here is current, non-current, but we will ignore items like provisions, deferred tax, and all of that. But that's what debt ratio looks at. The lower, the better for us here. Another one is gearing ratio, which they also call leverage ratio. And this one basically is looking at our debt, which is the interest-bearing debt, all over that debt plus equity, right? That's gearing ratio. This one we just look at the proportion of debt in our capital structure. Again, if it's too high, if it is higher than 50%, it means debt is more than equity, which is very bad. That company is said to be highly geared. That means he's faced with huge financial risk. Or it could just be interest-bearing debt over equity. In the exam, mostly the examiner will call this debt to equity ratio. As that's what I see them. So this is gearing ratio, but mostly when examiner talks about gearing ratio, they are referring to this first one, and they will call this one debt to equity. They measure the same thing, right? Because it's still comparing your debt and equity. Your debt should never be more than equity. If it becomes higher than it, it's a problem. And specifically, I'm talking about interest-bearing debt. So for this one, a ratio higher than 100% will be said to be highly geared. Then there is interest cover, which is how many times your PBIT can pay your interest. Okay, so of course, this one, the higher the better. PBIT all upon interest charged is your interest cover. So the higher the better for this. It shows how safe you are as a company. That means your PBIT is huge compared to your interest. Finally, is this cash flow ratio, which is now putting your cash flow on your debt, just to test that, do you even have money enough to pay some of your debts or all of it? This cash here is majorly the cash flow from operating activities. And finally, for today, is investors' ratios. And we have these ratios. There is earnings per share, which is the profits after tax, or the number of ordinary shares. This one, the higher, the better. It's just the return to shareholders. And there is dividend per share, which is dividend over number of ordinary shares. The higher, the better for this one too. Dividend cover, how many times your profit is able to cover or pay your dividend, which is profits over dividend. Sometimes this one can just be EPS over DPS. Then there is price earning ratio. From the name, is market price over EPS. And what this ratio measure is majorly the confidence of shareholders in a company, or the confidence the market has in a company. Because for a company to have high PE ratio shows is good. Is a good company. The higher the better for this ratio. It means that their earnings is small. For a company to have high PE ratio, their earnings is small, but their market price is huge. Because that's an anomaly. There is no way your earnings should be small and your market price is now big. The only reason is that even though you are paying small earnings now, shareholders or investors are still buying your shares just because they have trust in your ability to grow, and you will still pay them more in the future. So it just measures the confidence of the market in a company. And there is a dividend yield, which is a measure of returns to shareholders. This is a better measure of returns than dividend per share, because this one is now looking at how much are you even paying for each of the shares. It's just like having two companies, A and B. A is giving a dividend per share of, let's say, 2 naira, and B is giving a dividend per share of, let's say, 4 naira. But A, if you want to buy shares of A, is 1 naira per share. With 1 naira per share, this guy is giving you 2 naira, double. But B, if you want to buy their shares, is 4 naira, and they are giving you 4 naira as dividend. A is better. A is better because it's returning your capital by almost 2 times. So that's dividend yield is talking about. And those are the popular shareholders ratio. And these are the ratios I really need you to have in mind. So practice this ratio so that in the next class, we will be able to solve past questions And I would like you to look at this at your leisure time. This limitation of ratios, I want you to look at it. Just read it up. And limitation of financial statements. I want you to also look at that because the examiner usually asks, and some other information I have in these notes that I've shared with you. Okay, so that is analysis and interpretation. So please revise it against our next class, where we'll be looking at last diet correction. Right, when we look at last diet correction, I will also look at ethics. So those are the two things we basically look at next week: ethics and last diet correction on ratios for next week. Okay, so do you have any questions for me?
Yes, sir. Good evening, sir. So
Hi.
my question is, I don't know how I'm going to say, it's not really pertaining to the work. It's just for us that are first timers in writing ICAN, right? I just wanted to ask that the questions, does it have to be in the same order, or I can start with a question in section C or B before I treat the one in the first in section A?
Okay, so you can start in any order. You can start in any order. So I will still talk about this extensively. In fact, the thing is that you can start from 7C in the first page. Then in the next page, you can go and do 1C. Then in the next page, you can do 3D. So that goes to tell you that you don't necessarily have to finish question 1 before you go to question 2, right? So you just ensure that every new question starts on a new page, especially when it's not orderly and is well labeled, so that whoever is marking can mark right. And again, you need to ensure you're not answering more than the required questions in each section. Otherwise, they will mark everything, but they will pick the one you got the lowest mark. They will pick the one you got. It's just like while you are scattering it around, yeah. Sections D, for example, now, if there are 3 questions, they will say answer 2, right? So if you answer 1, 2, yeah, you now mistakenly answer 3D, right? So the guy will only mark, he will mark everything, but it's 3D that they would award you. The one of it, that 1 and 2 that you fully answer, they will just remove the one you got the highest. They're always like that. So they know that you're just trying to be smart. That's the interpretation. So you can answer the questions in any order. Any order. Just label it well and ensure you don't answer more than the required question in each of the sections. Okay, in each of the sections. Okay, I hope I answered your question.
Yes, thank you so much.
You're welcome. Okay, any question? All right, so I think we should go and have some rest. Then I will see you guys again for my class next week, Tuesday, where we'll be solving last diet question to teach you how to analyze majorly. That's the intention. I want to teach you how to analyze these ratios and how to answer them in the exam, because it's so important. It will always come out, either this one or EPS. It will always come out. If you don't know this one, don't go to the exam. And the last class I had also, you must know that one very, very, very well, but it will always come out, right? And even ethics, that's why most students will pass CR. So the ones that don't pass are the ones that were not well guided, or the one that did not listen to guidance. So that will just go and spend the entire time on group accounts. It's just 25%. And if you know it so well, maybe you get 20/25. And the time itself will not even be enough. So, or accounting standard, that there are so much, it's just a lot of them. Though I will narrow it down to some, the ones we have even taught you are the ones that we prioritized. But the reality is that it's just 20% of your syllabus. So you have to be very careful that you are not taking the entire time reading just standards. Please, standards group together They are just 45% of your syllabus. But you see these other simple parts, don't joke with them. Prioritize them from now going forward. That's why we are teaching them close to the end. And there's this one I taught, first topic, regulatory and conceptual framework. You need to go and pick that one too up. These are questions you will find in your exams. These are questions that would actually make you pass CR. So don't fail. No student should fail CR because it's always like that. So next week, we would confirm what I'm talking about. And upper week also, usually we'll just be reviewing past questions in that final week because we have done more than enough for you guys to go and write the exam in May. But for today, we need to go and rest. So I'll see you next week. Bye for now.
Thank you,
Thank
sir.
you.
You're welcome.
Thank you so